when you become your own banker, when you actually pay yourself, in essence, what the banks were doing. Don't do what the banks tell you to do with your money. Save in a CD, save in a savings account. Don't do what banks tell you to do with your money. Instead, watch what the banks do and go do that instead. Act like a bank acts. Lend to yourself and lend to those around you and become your own source of financing. Buy back your debt. Don't just pay it off, but buy back your debt. Learned, and this is what I did with my student loans, and we can get into exactly how it happened with tactical strategies and more, but actually become wealthy through your own debt repayment strategy. Don't just become debt free, become better than debt free. If I ever do call Dave Ramsey's radio show, I know he's got that debt free segment. If I ever call his show, I'm going to scream, I'm better than debt free, because there is something better than just being debt free.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your assets from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Mark Willis. Mark Willis is a certified financial planner and is a man on a mission to help you think differently about your money, your economy, and your future. Mark is a 3-time #1 best-selling author and the owner of Lake Growth Financial Services. And in just a minute, we're going to speak with Mark Willis about buying back debt. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple ways you can, or a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Mark Willis. Welcome to CREPN Radio.
I appreciate it. Thanks so much for having me on.
Well, I'm delighted to have you and looking forward to our talk. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. In my professional experience as a CFP, I've got the great privilege now of working with real estate investors, business owners, even some NFL Super Bowl champions. But most people that I work with just want more security, assurance, agency, control over their finances, their real estate portfolio. Like I said, most of our clients are in real estate at some level or another, whether they're doing flipping or rentals or the BRRRR method, wholesaling, syndication deals. They might be an LP or a syndication manager, or they might just want to be dabbling into real estate and just looking into the prospects of what it means to incorporate that into their portfolio. This right there makes me not so average. In fact, that's our show. It's not your average financial podcast. Because typically CFPs point people away from real estate and into whatever the CFP can get paid for. The assets under management of a typical mutual fund or an IRA or stocks, bonds, mutual funds, and all the, I call them retail amateur investment products of stocks, bonds, index funds, ETFs, that stuff. That's the buying the retirement at the mall, in my opinion. My background is not in finance. I grew up with really no awareness of money. We were very much working poor. I was able to make it through college, but I got out of there with 6 figures of student loan debt. And we graduated. I had my fancy master's degree, graduating in 2008. What a wonderful year to be looking for work, right? And so, with all that debt and with really no real job, I was forced, and my wife and I were forced to face this this lurking demon in our marriage called money. We had to figure that thing out quick. In fact, I jokingly say I married two women in college, my gorgeous wife and Sally Mae. And Sally Mae was not welcome in our relationship. So we had to find a better, and I think we did find a better way to become debt free, better than debt free, in fact. And partly that's one of the strategies I'd love to talk with you about today.
Yeah, I would love to get into it, and definitely looking forward to our conversation about it. Um, so let's, I guess, kind of the first question, I have is money. I think everybody, like you mentioned, you go to school. The expectation is to get a good job, working for a number of years, build up a nest egg, and then be able to retire. Um, I'm curious, uh, in today, as opposed to what may have been more possible in our parents' or grandparents' generation. How ready is the average employee with respects to the path they're on and the ability to retire?
Wow. How ready is our current generation as opposed to maybe our previous generations? I think every person, if they are honest with themselves, could answer that question with a big fat upside down thumbs up, right? It's a thumbs down situation. Many people are dealt a difficult set of cards for sure, with inflation and market volatility, prices of houses specifically. It's getting harder to be a first time home buyer. Over the last 4 years, we've had a 60% increase in the median price of a house, and that means the median income would need to go up by 60%. I don't know about you, but I don't know many people who got a 60% raise over the last 4 years. So yes, it's getting harder, but we've also gone from being a nation of savers to a nation of debtors. In 1940, the U.S. Census Bureau put out a statement or a survey saying that the average American saved about 33% of their income. Now it's almost flip-flopped. We now spend a third of our income on servicing debt, according to the recent U.S. Census Bureau's research. So that's unbelievable. I mean, think about that for a minute. If time is money, what is a third of your day? And specifically, it's 36% of our income is going to service debt. Now, a lot of your listeners may be better than average and good for you, but that means somebody else listening might be twice as bad as 36%, in debt. Servicing, I mean, that means we're slaves to banks most of our waking hours. If you factor in that we're sleeping 8 hours a day, hopefully, I don't see that as a winning formula for helping you get ahead or even maintaining. And a lot of people will say, well, Mark, I've refinanced all my mortgages on my rental properties back when rates were 3 or 4%. Great. That's awesome. However, uh, I'm always looking to eat healthier, and I'm always looking to do things better. And I just so happen to notice that it doesn't matter the rate of how much I eat my donuts and my ice cream. It's not the rate, it's the volume that can kill you on your health, right? It's the volume of your interest that will kill you. It's not the rate, it's the volume. We had a guy, he was a really well-to-do doctor, making, several $100,000 a year. And he was very proud of his mutual funds and his 401k earning 12% a year, whatever. That's great. Great, great, great job. And however, as we got into his financial situation, I do this with every client I meet with. We have a one-on-one, just detailed discussion about their concerns and where they're at financially and where their debt is and where their income is. This particular person had roughly 80 grand a year of his $250,000 salary. 80 grand was going to service the interest on his debt, his boats, his cars, his medical debt, his credit cards, his second mortgage, his HELOC. The rates were all pretty low, but he was spending the volume was close to 30% of his total take-home pay, was just going to, you know, pay a banker for the privilege of being in debt to that bank. To me, that's not a winning formula. You'll never get ahead, no matter what rate of return you got on your mutual funds, if you have that kind of a problem with debt. And again, even though he had low interest here and he could manage the payments there, it was the volume that was killing him. And that's true with banks, and it's been that way for thousands of years.
Yeah, I think that statistic about 30% saved versus 33 or 36% now currently going to a service debt, that's kind of depressing. Uh, but I think, and I'm kind of curious, uh, is there a more recent time in history that you can point to where the delta on that changed dramatically? Because I'm assuming that it didn't. Um, well, I'm assuming that it changed dramatically when some of the banking laws changed and capital became a lot more available than it once was.
Tell me
Is
more
that
about that.
well? And I say that from a standpoint of just, and I'm not a historian per se, but I know that growing up, my dad was a banker, and it was all about put your money in the bank. You know, you got interest on the savings account. And then somewhere along the line in my adulthood, it feels like uh, lending became much more available. Credit cards, seconds on homes, leasing, all of these debt instruments became much more available and almost necessary in order for the economy to continue to sell the goods because of the price of the goods. And then I think the ultimate that I recognize, this is just Darren, according the world according to Darren, is that the banks were able to position themselves and always create these instruments and benefit, whether it be through fees or interest or whatever it was, and that the manufacturers or whoever um, the company that was trying to sell their wares relied heavily on these new instruments, which also the thing that people don't always think about is the easier it is to get money, it allows the inflation of the cost of the goods to increase because now we're not talking about the cost of the good, we're just talking about the payment
Hmm.
uh, in relation to your income.
That's
So
right.
in the example you gave that the cost of the median cost of a house has gone up 60% in the last 4 years. I know that the median income didn't go up 60%, but what my experience has been, and I've witnessed it, and it was kind of the aha was buying a house when there was high interest rates and feeling like I could barely get into the thing, and then all of a sudden interest rates dropped, and I was able to refi, and my
Hmm.
payment went down. Um, and at the same time, when the interest rates went down, the cost of real estate went up because again, the payment buyer was a payment buyer. They weren't buying, they weren't plunking down the cash to buy the real estate at the time.
Well,
So
we certainly have seen that. You could look at the square footage of houses over the last 60 years. You know, the grandparents, you asked about parents and grandparents, their square footage was much smaller. And you're right, we've gone through the last 40 years has shown us what low interest rates does to people's capacity to think critically. We buy, 10-bedroom houses for a retired couple. It's interesting to think, wow, do we need are we buying things irrationally? Lowering the interest rates does funny things to people's rationality. I can invest in some harebrained scheme. I always jokingly say when interest rates go down to below sub-zero levels, like they almost got, I mean, they were so minuscule. You could invest in the green golf ball company or the doorless microwave company or the glow in the dark sunglasses company. All these, I'm making up sort of silly examples, but like, why would you ever need a glow in the dark pair of sunglasses? Think about that for a minute. Or a doorless microwave. These are all foolish ideas, and that's sort of what happens when money becomes essentially free. And you're right. The most important thing you can do is ask yourself, well, who benefits from the decisions I'm seeing take place? And I don't know if it was bank laws. It might have been. It certainly was the movements of the Federal Reserve, which is the grandpappy of all banks, which was created just 111 years ago on an island called Jekyll Island, which sounds like the start of a crime scene thriller, if you ask me. But there's a great history here, and we don't have probably time to go into a lot of it, but check out the book called The Creature from Jekyll Island by G. Edward Griffin. Great book. It does read kind of like a crime novel, and it really speaks to the control that many central bankers have had over our country for many years. I'm no tinfoil hat theorist, but this is just the fact. When we had higher interest rates, you could be a saver. Now you're kind of a schmuck if you save. If interest rates are at 1% and you could go borrow that money and invest it in the stock market, well, that has a lot to say about why house prices have gone up, why stocks have gone up. When you see you could borrow money at 1% and you could go get 12% on a mutual fund, especially as baby boomers have pumped up the price of the stock market. The last 30 years have been a great boom for investors and speculators. Now, as we start to see inflation rearing its ugly head, and as boomers begin to retire and suck money out of their 401ks to buy groceries and spend money on the grandkids, that's going to have an interesting effect on the overall market, both in terms of the stock market and real estate market. And once again, it's kind of cool and kind of sexy to be a saver, to kind of put it mildly, but not in the traditional methods. Most people think, when you were in 1978 and 1979, 1980, just go get a CD and live off the interest. You still can't do that today, but there are some incredible tools and strategies that my clients are able to implement that we call not so average financial strategies. Some of them have been around for hundreds or even thousands of years, these strategies, but they are certainly not average. And I don't want to be average. I want to be awesome. When it comes to my finances, if average means being up to my eyeballs in debt, or hoping and praying the bank doesn't come and collect my car or my house or whatever, I don't want to be average. I want to be weird in a good way, let's say.
Now, so let's talk a little bit about some of these strategies or opportunities that you have. I mentioned buying back debt. It was one of the topics that caught my attention. I'm kind of curious, what do you mean by buying back debt? What is that?
Yeah, most people think the best we can ever do is being debt free. So let me start with a fun story. Let's imagine you and I want some deep dish pizza. We're out there on the Pacific Northwest. We want some deep dish Chicago style pizza. You have a prop plane. Maybe you've got your pilot's license, and your prop plane, your Cessna or whatever, can fly. Let's just say it can go exactly 100 miles an hour. So we get up in the early morning, we start flying to Chicago. We might be there by lunchtime if we do it right. I don't know. You can do the math on that. Maybe not. Let's see how fast that plane can fly, right? So we get going, but there's a headwind coming right at us. And that headwind, let's say, is a blast of a gale force wind, 200 miles an hour coming right at our face. Darren, I'm not great with quick on the fly math, but if you can push into the wind 100 miles an hour and it's pushing on you 200 in the opposite direction, are we ever making it to Chicago?
No, we're going west.
We're going to be in the Pacific before we know it.
Yeah.
So what's the best thing we can do? Well, we can land our plane. And most people think waiting for the wind to die down and then flying with nil wind, as it said, would be the best case scenario. They think that that's the best you can do. This is the arrival syndrome, thinking that we've made it. We can do no better than flying 100 miles an hour towards our destination. And it's true, you do improve your scenario when you're not getting pushed by a headwind. Well, let's kind of bring down the metaphor for a second. Most people are trying to squeeze out a giant rate of return with a little bit of savings. They can save a little bit in their 401k, or they can plunk a little bit down for a real estate project or whatever, and they're hoping to get a giant rate of return. They're putting more and more on the casino table with less and less of their savable income. So, the best they can do, they think, is let me pay off all my debts, pay cash for my cars, let me pay cash for my houses, let me be a cash buyer, and that's as good as it gets. That's thinking, all right, let's get rid of the debt, let's get rid of these banksters, and let's just pay cash for everything. They think to themselves, this is as good as it gets. But this is not as good as it gets. Darren, we could make it to Chicago from your neck of the woods out to Chicago by lunchtime. The only way we could do it is with a tailwind. right? If we had a tailwind pushing us at 200 miles an hour plus our engine speed of 100, we might actually make it to that delicious deep dish. So what is that? Well, that's when you become your own banker. When you actually pay yourself, in essence, what the banks were doing. Don't do what the banks tell you to do with your money. Save in a CD, save in a savings account. Don't do what banks tell you to do with your money. Instead, watch what the banks do and go do that instead. Act like a bank acts. Lend to yourself and lend to those around you and become your own source of financing. Buy back your debt. Don't just pay it off, but buy back your debt. Learned, and this is what I did with my student loans, and we can get into exactly how it happened with tactical strategies and more, but actually become wealthy through your own debt repayment strategy. Don't just become debt free, become better than debt free. If I ever do call Dave Ramsey's radio show, I know he's got that debt free segment. If I ever call his show, I'm going to scream, I'm better than debt free, because there is something better than just being debt free.
Well, you piqued my interest. I'm curious. What do you tell me how you did what you did, or buying back your debt there? I mean, I understand the concept of you know I mean there's strategies with banking and insurance and that kind of thing, but I'm curious how did you go about uh better than I mean to buy back your debt and get better than debt free?
Sure. Yeah. Well, so this will take a new way of thinking for most people. And, I think who is it who said, Will Rogers says, even if you're on the right track, you'll get run over if you just sit there. So it is going to take motion and action and a new way of thinking. And this was for me a big, difficult pill to swallow because I was such a great Dave Ramsey fanboy when I first heard about this concept. But when you can design, of all things, a dividend paying whole life insurance policy in a specific way, it acts a lot like a bank. All right. So it's not a bank, obviously, it's a life insurance contract, but it acts like a bank in all the functions and features we need banks to act for us as. So, I had to get past my own bias. Maybe some of your listeners have similar bias to that phrase, whole life insurance, but just set that aside for a minute. Keep an open mind. Let me kind of explain how this works. When you have a true bank on yourself designed whole life policy, the policy grows with cash every month, every year on a guaranteed basis. So there's never a year that you will have less money in the account. Contractually speaking, it's going to increase in value, and there's not anything we can do to stop that growth. That's pretty cool. No matter what the stock market does, it's going to keep growing. No matter what real estate markets do, it will always be more. Second, the money is liquid and accessible to us, meaning we can get it for any reason without penalty, which is pretty cool, and without taxes due, which is very cool. Especially if we see ourselves going into a future where taxes might go up. Third, it is life insurance, so we can leave our family more than we could ever save for them due to the fact that it's life insurance. That's just, actuarially speaking, that's how it's designed. And then fourth, and this one's huge, if it's designed properly, Darren, you can borrow against the cash value, much like a HELOC, if folks are familiar with how home equity lines work. You can borrow against your cash value, and the policy would continue to earn interest and growth as if there was no loan taken against the account. So you might have, let's say, $100,000 of cash value. And let's say you wanted to borrow out $80,000 to buy a car. That's a nice car. You could borrow against that cash value, which is 100 grand, go buy the car for 80 grand. The policy is still growing with guarantees and also dividends on the entire 100,000 bucks, as if you hadn't touched a dime of the money. And now you've got a policy loan against that policy, but you're the banker. In essence, you get to control the repayment plan. There is no forced repayment schedule to that policy. You can put it back at a couple bucks a month. You could skip a few months. You could throw it all off, pay off the whole thing in 5 years, or even take that loan to your grave. The loan would just be deducted from your death benefit when you pass away. So this to me is, and it was the way we paid off all of our student loan debt that I had accumulated in college. It allowed me to plow money into my policy, build up an asset as early as I could, because the younger you start saving assets, the more valuable compound growth is for you, right? So we plowed as much as we could in there, and then we would borrow against that policy to wipe out the student loan, and then the next student loan, and the next, until they were all gone. We had bought back our debt. We hadn't just paid off the debt. The liability became for us an asset. It was now our loan to ourselves, and we've since repaid the policy loans, and we're clean and clear there. But we now have an underlying asset that continues to compound for us and will for the rest of our lives.
So tell me, I get the concept, whole life, cash value, life insurance. Is that kind of the vehicle?
Yeah, it's a mouthful, sure. Yeah, we just
Okay.
call them bank on yourself type policies
Okay.
for short. Yeah.
Okay. Is there any specific carrier that offers a product that works better, or is this universal as far as the different types of, or does every carrier offer this or something
Great
similar?
question. Yeah, this is actually, the best analogy I've come up with is if you've ever been to the grocery store and you're looking for the USDA organic peanut butter, let's say. There's maybe next to the USDA organic, there's all natural. Now, savvy shoppers might know there's a big difference between the words all natural and USDA organic with the green seal and everything. There is, not much regulation around the words all natural. Similarly, there's almost no regulation around this concept that you and I just described. There are 400,000 life insurance agents that I'm aware of in the United States, as far as my research. And almost any of them would love to sell you a life insurance policy, right? However, and as far as I can tell, roughly 1,000 life insurance companies, small and large, across the United States. Most of them would not be worth doing this project with. Most of them. You really need, there's a number of filters, maybe 20 or 30 filters on how to design this properly. Here's a couple of the big ones. You want it to be a mutual life insurance company. You want it because it cannot be publicly traded. Otherwise, dividends go to the shareholders. You want it to be a mutually owned company where the profits stay with you. Second, you want it to be dividend paying, whole life insurance. There are a number of other chassis out there, universal life, variable life. You don't want to work with products like that for this purchase, for this purpose. I'll give you two more. It needs to have a paid up additions rider on the policy. That's key in order for this thing to grow significantly. Most people think, well, whole life insurance is just a big commission check to the agent. If we designed it right, there's going to be a significant paid up additions rider on the policy, which pays almost no commissions at all. So we cut commissions by 70%. That allows a lot more money to go right into the policy itself, which is now that it's my client's cash. It's theirs. They should keep that money, right? I don't need to retire before they do. And as a fiduciary and as a certified financial planner, I feel like that's the right move to make. Fourth, and finally, it needs to have what's called non-direct recognition loans. Now, I realize that's a lot of vocabulary, but non-direct loans it allows for that strategy where you can borrow against the policy even as it continues to compound and grow like there was no loan. Otherwise, we keep breaking compound growth. If we don't have that particular function, every time you access your policy, it would crash the growth of the policy. And this is not unlike a savings account or 401k. When you withdraw money out of your savings account, crash, right? You stop the growth of that money. But when you have a non-direct loan feature, non-direct recognition loan feature on these policies, you're able to get two uses of your money for the price of one. So again, a lot of vocabulary there. If you don't remember anything else, just remember bank on yourself is the design, or the USDA organic, you might say, to make sure all of those features are set up properly.
So as a CFP, is this a product you sell, or is it just something you work with your clients to find?
I am a CFP, so I don't recommend any strategy until I've met with someone and I believe it's in their best interest. As a fiduciary and as a certified financial planner, I'd be remiss if I didn't look at your entire situation first before jumping to any conclusions. I do find it a compelling strategy, and so I do sell it to clients, and I do show them the pros and the cons before we make any recommendations.
And obviously, with life insurance, it's a whole lot more affordable to buy it when you're young and healthy. Is there a an age at which you find that it's somebody's past the line of making sense as far as the strategy goes?
Oh, great question. Yeah, you're right. The death benefit would be larger per dollar if I was 21 years old instead of 41 or 61 or 81. The younger you are, the bigger death benefit you can buy for the same premium. However, this is a bit different because we're cutting the expenses and the costs and the commissions. We're trying to shrink that death benefit down as small as we can and lift up the cash value of this policy as much as possible. Hence, age is less of a factor. The growth of the cash value will be the same for a 62-year-old as it would be a 32-year-old. The growth of the cash value is going to grow the same, as long as you're in reasonably good health, you can have a very similar growth of your cash value. Now you'll have a smaller death benefit than the 32-year-old or the 18-year-old or whatever, but the cash value will be significant day one, month one. So to answer your question, Darren, we've had clients who buy policies even up to even up to age 85.
Wow. Uh, yeah, I mean, because I think traditionally, when one looks at a life insurance policy, it's about the death benefit,
Mm-hmm.
uh, and the mortality tables and the cost goes up. Uh, the older you get, less healthy you are, closer to the expiration date,
Mm-hmm.
uh, kind of thing. Um,
Graduation date. I say
oh,
graduation.
graduation. There you go.
But
Yeah.
I'll tell you, I had a guy one time, he had a open heart surgery and that made him uninsurable for that reason. But he loved this concept and he wanted his entire family to become a bank unto themselves, right? So what could he do? He's uninsurable, but he got a policy on his wife. He opened and owns policies on all of his adult children and all of his grandchildren. Even though he was uninsurable, he was the owner of 12 different policies and still is the owner of 12 different policies. And he has regular meetings with his family to go over the policies, how they're doing, the dividends they just got last summer. They're talking about investing as a family into real estate projects, paying off their grandkids' student loans when they go to college. What an unbelievable opportunity for a family to change the family tree. Like what in Wall Street allows us to do that? I can't find anything. Now we are a full financial firm and even this tool, cool as it sounds, has its own costs. I always tell folks don't just jump into this. Again, the biggest risk is that it was designed improperly. The next biggest risk is or the next biggest consideration I would say is unmet expectations. A lot of people go into this looking at whole life insurance and trying to compare it to say an investment. It's not going to do 30% rate of return. You're not going to have great whiz bang rates of return on these policies. They're going to be in the middle single digits most of the time. And that is a tax-free return, 5% or whatever you might get. That's a nice return when you consider that it's tax-free if we designed it properly. But it's never going to be 32% like you might get on certain years of the market, or you do a great job with your real estate flip or something like that. So keep that in mind. These policies are meant to be a savings alternative. Again, it's better than a savings account, better than a CD, better than a money market account. But it's not meant to be a replacement for your investments.
Right. And the ultimate, I guess, if you were to compare, it's either paying yourself or paying the bank. Is that essentially the comparison? I mean, if I go borrow money at the bank, there's an interest rate that I'm being charged, versus if I save the money in a life insurance, a whole life policy like you described, and then borrow that money from me, that for myself, and pay it back, that is that not the same? Am I tracking as far as the concept? I mean,
Mm-hmm.
because I guess what it comes down to is the either some sort of a starting amount to where you've got to build it to something, because can you borrow more than what's the cash value of the
No.
account?
Yeah,
Okay.
that's another consideration. Some folks say,
Okay.
well, I just want to use other people's money and I don't want to save myself, Mark, and I can't say, or they'll say, I can't save. And I will tell them, I understand. I was there. I was a skinny kid with 6 figures in student loan debt and no plan and no job. Somehow I figured out a way to start scratching together a little bit here and there. My first 2 policies were modest, a couple $100 a month each, right? But we tried to make it work. We had the side jobs, and it probably took my wife and I an extra 6 to 9 months to pay off our debts by doing this strategy rather than just throwing money into the hole, rather than just paying the debt down directly. We could have paid the debts off a little faster, but it would have taken us 3 to 4 years, and we would have been 3 or 4 years older before we started our savings project. Instead of that, by starting the savings project first, by opening our policies younger, yes, it took us a few more months to be debt free per se, but remember, our assets, the whole life policies, were now compounding. They were like a snowball going downhill. Nothing could stop that growth at that point. So I found a few ways to do it. I was very much not well to do, let's just say. Working poor puts it mildly. My first job after my fancy master's degree was at a property management company with a wet, dry vac underneath an elevator. I'll just let your imagination do the rest, okay? And so it was not a glorious time for me, but we started it. We figured it out. Again, like I said earlier, even if you're on the right track, you'll get run over if you just sit there. Will Rogers, right? So continue to say, how can we make this possible? Even if it seems difficult at first. And the last thing I'll just mention is when it comes to OPM or other people's money, it sounds great while times are good to borrow other people's money to make money off that. But Darren, I don't know about you, but usually other people want their money back. And when do they want it back? Is it when times are good or when times are not so good?
Well, like I've come to recognize, if you have money and you're trying to borrow money, it's always easier to get it.
That's right.
So when you need money and you don't have any, that it's you're not as attractive of a risk. So
That's right.
yeah.
That's right. Yeah. Who was? Oh, Mark Twain said, a banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back as soon as it starts to rain.
Right. Yeah, love Mark Twain. No, it's interesting in just the whole concept and the ability to kind of change the script on your finances and use some tools to pay yourself and also create some sort of a safety net and or you know additional ways to protect your family and help your asset growth there. It's all fascinating and I know lots of people. In fact, I just talked to a woman here just a little bit ago, was commenting exactly like you said. Her father had been told early in his career, get into real estate and get a whole life policy, and he did that for each one of his kids, and they were able to borrow against that for their college, pay it back. And also then it was a vehicle for them to get started investing in real estate themselves. So interesting that
Yeah.
I'd be talking to you right after that.
Well, that's actually very, what's funny, it's sort of like the red Corvette syndrome. When you buy a red Corvette, you start seeing them all over the place. There's that awareness that it's sort of out there. Folks just look up on the internet, look up a corporate owned life insurance, or even this, look up bank owned life insurance. These banks, they're some of the biggest purchasers of this strategy, of these whole life policies. And you're exactly right, Darren. We don't have time to get into it today, but I talked about how I paid off my student loans, but we've since used it for all the things that you just mentioned significantly when it comes to real estate investing. Can you imagine how cool it is when you can access money when banks are not lending or they're raising the rates on your HELOC or whatever? But you've got this big pile of money. You can go invest and buy that real estate deal when everyone else is having difficulty kissing the ring of the banker to get their loan. You get to become much more competitive, and your policy is still earning while your real estate is appreciating. So you can get some arbitrage there.
Yeah. No, it's definitely worth checking out and learning more and figuring out how it'll work for you. Appreciate that. Hey, Mark, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we're unable to avoid or minimize the risk, then we look to see if there's a way we can transfer the risk.
Mm-hmm.
And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be the banking laws or the interest rates or the way the money system set up or whatever it is that you consider and recognize to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Mark Willis, what is the biggest risk?
Well, I was thinking about this some. The biggest risk is there's so many layers to your great question, and with enough time and enough adult beverages, we might get even deeper than this. But here's a good start anyway. There's a quote by Terry Smith. He says, "There are only two types of people when it comes to market timing: people who cannot do it, and people who have not yet realized that they cannot do it." So what do I mean by that? What does he mean by that? Well, what I guess I'm taking away from that is we are our biggest risk. The arrogance that comes with humanity's arrival syndrome. And this is something Nelson Nash came and showed me. He said the biggest threat to human survival is the arrival syndrome. And that is the idea that we have made it, that we have found the pinnacle of existence, that we know it all, that we know what the market's going to do tomorrow, or that we know how to buy our next car, or we know how to invest in real estate, or we already have figured out that whole life insurance is blank, whatever bias we have, right? To use today's examples. But this could expand itself to everything. We know what the future government's going to look like, or where taxes are headed, or, what our kids are going to do when they graduate college. We don't know nothing is, I think, the refrain of avoiding the arrival syndrome. So to me, that is the biggest risk.
No, that's great. Mark, where can listeners go if they'd like to learn more or connect with you?
Thank you for the opportunity to be on your show today and to speak with you and your audience, Darren. Thank you. If you're interested in looking at this strategy in depth, if you'd like to just take a little bit more of a tiptoe into this concept and maybe have a few questions of yours answered, I can help. We work with clients in all 50 states, and we work with real estate investors, business owners, and even just W-2 folks that are just trying to sock away a little money or pay off some debt. You can go to kickstartwithmark.com. That's kickstartwithmark.com. And we would set up there a 15-minute phone strategy session where we get to know you and answer your questions, see if this strategy, like bank on yourself or something similar to it, would help you. So that's kickstartwithmark.com.
Awesome. Well, hey, Mark Willis, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you, sir.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Till next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.